stop scrolling. Did you know you can now invest in big Hong Kong stocks like Alibaba, Tencent, and HSBC without opening a foreign brokerage account, without paying crazy fees, and without worrying about currency exchange rates? That's right. With just your SGX account, you can now own shares in some of China's biggest companies at a fraction of the usual cost through Singapore Depository Receipts SDRs. Want to know how this works? Stay with me until the end because I'll show you exactly how to invest, which SDRs pay dividends for passive income, and the pros and cons you need to know before jumping in. And if you love easy-to-follow investing topics, smash that like button, subscribe to Wealth for You, and let's build that cash flow-rich future together. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Chapter 1. What are SDRs? Alright, so what exactly are SDRs? SDRs are like mini versions of foreign stocks that trade on the Singapore exchange SGX. They represent ownership in a Hong Kong-listed stock but are priced in Singapore dollars. So instead of opening a Hong Kong brokerage account, dealing with foreign currency risks, or forking out thousands of dollars to buy full shares, you can invest in these companies easily through SGX. And here's a major advantage. When you buy SDRs on SGX, they are held in your name with Central Depository or CDP as custodian. This means your investments are securely recorded under your own CDP account. But if you buy Hong Kong stocks directly from a broker, your shares are not held under your name. They are kept in a custodian account owned by the broker. This means you don't have direct ownership of the stocks, and in some cases, you may face additional fees or restrictions. So with SDRs, you get a safer and more transparent way to invest in Hong Kong's biggest companies right from Singapore. Chapter 2. Which Hong Kong stocks can you buy as SDRs? SGX now offers 8 Hong Kong blue-chip SDRs, covering major sectors like technology, finance, and electric vehicles (EVs). Here's the full list. Alibaba, e-commerce and AI. Tencent, gaming, AI and cloud computing. BYD, electric vehicles. HSBC, global banking. Bank of China, state-owned banking. Xiaomi, smartphones and smart devices. Meituan, food delivery and e-commerce. Ping An Insurance, financial and healthcare services. If you're focused on passive income investing, take note that HSBC, Bank of China, and Ping An Insurance pay dividends. Chapter 3. Pros and cons of SDR investing. Let's dive into the benefits first. 1. Lower investment costs. SDRs are broken into smaller units, making them more affordable. For example, a BYD share costs approximately $72 in Hong Kong, but on SGX, one BYD SDR costs just $7. You can start with as little as $700 on SGX instead of $35,000 on the Hong Kong Stock Exchange. 2. No foreign exchange risk. Since SDRs trade in SGD, you don't have to worry about currency fluctuations between SGD and HKD. 3. Convenience. You don't need a Hong Kong brokerage account. You can buy and sell SDRs like any SGX stock through your regular broker. 4. More trading hours. SGX trading hours are longer than Hong Kong's, so you can react to market news even after the Hong Kong market closes. 5. Exposure to growth sectors. Want to invest in AI, electric vehicles, e-commerce, and banking? These SDRs cover it all. Now let's talk about some of the drawbacks. 1. Not all SDRs pay dividends. If you're a dividend investor, you'll want to focus on HSBC, Bank of China, and Ping An Insurance since they provide regular passive income. 2. Liquidity risk. SDRs are new, so trading volumes may not be as high as direct Hong Kong stocks. This could mean wider bid-ask spreads or lower liquidity at times. 3. No voting rights. Unlike owning Hong Kong stocks directly, SDR investors don't get shareholder voting rights. But for most retail investors, this isn't a big issue. 4. Different SDR ratios. Each SDR represents a fraction of a full Hong Kong stock. For example, one Tencent or BYD share equals 10 SDRs, while one Xiaomi share equals 2 SDRs. You'll need to check the ratios before investing. Chapter 4. How to use SDRs for passive income investing. If you're a Singapore investor looking to build cash flow and passive income, here's how SDRs can fit into your portfolio. HSBC, Bank of China, and Ping An Insurance SDRs. These pay regular dividends, making them great for long-term income. HSBC in particular is well known for its high and stable dividend payouts. Mix growth and income. If you want both growth and dividends, you could combine dividend-paying SDRs like HSBC with high-growth stocks like Tencent or BYD. Start small and dollar cost average. Since SDRs allow smaller investments, you can use dollar cost averaging to build your positions over time instead of buying all at once. Final thoughts. SDRs are truly a game changer for Singapore investors who want easy and affordable access to Hong Kong's top companies. Instead of worrying about high capital requirements, foreign exchange risks, or complex overseas brokerage accounts, you can now invest directly through SGX in SGD, just like any local stock. For dividend investors, this is even better news. HSBC, Bank of China, and Ping An Insurance SDRs pay dividends, making them great options for passive income. If you've been looking for a way to build long-term wealth with cash flow, SDRs can be a powerful addition to your portfolio. So, what do you think? Are SDRs something you'd invest in? Drop a comment below and let me know. And if you found this video helpful, hit that like button and subscribe to Wealth for You, so more people can learn how to invest the smart way and become cash flow rich. Thanks for watching, and I'll see you in the next video.